Hey everyone, welcome back to Corporate Decoder, where we unearth the surprising truths hidden within companies' financial reports. And today we're diving deep into AvePoint's latest quarterly checkup, which feels a lot like seeing a company finally hit its stride after some serious growing pains. This report is all about their performance in the second quarter of 2025. And let me tell you, there are some numbers here that really tell a story about where this company is headed. We'll break down their revenue, their expenses, and see if they're really delivering on their promises. And if you enjoy these kinds of deep dives, make sure you're subscribed to the channel and join our Discord community in the description below for more exclusive content. First off, let's look at the big picture. For the 3 months ending June 30th, 2025, AvePoint brought in $102 million in revenue. That's a solid 31% jump from the same time last year. But what's really driving that growth? It's their SaaS or software as a service offerings. SaaS revenue surged by a massive 44% to $77.3 million. This is huge because SaaS is often where companies see recurring revenue, meaning customers keep paying for their services month after month or year after year. It's like a steady stream of income that's much more predictable than one-time sales. This surge shows that their cloud-based solutions are really catching on. Now, not everything is going up. Their term license and support revenue actually went down by almost 19%, and maintenance revenue, which usually comes from older software versions, dropped by over 54%. This isn't necessarily a bad thing though. It actually shows AvePoint is successfully shifting its focus from selling older software licenses to their newer, more profitable S10s products. It's like a company pushing its latest smartphone model and seeing sales of older phones naturally decline. Looking at where the money's coming from, North America is strong, but EMEA, which is Europe, the Middle East, and Africa, saw an even bigger jump in revenue, up nearly 38%, with SaaS revenue in that region climbing a remarkable 50%. Asia Pacific also showed healthy growth. This global expansion is a good sign for AvePoint's long-term stability. Now let's talk about what it costs AvePoint to make that money. The total cost of revenue jumped by about 40% year over year. A big chunk of this increase, around $3.2 million, comes from higher hosting costs, which makes sense given the huge growth in their SaaS business. More customers using their cloud services means higher infrastructure costs. They also saw a rise in personnel costs contributing to this increase. Despite the rising costs, their gross profit, which is what's left after taking out the direct costs of delivering their services, grew by almost 28%. Their non-GAAP gross margin remained strong at 74.8%. This means for every dollar of revenue, they're keeping about 75 cents after covering the direct costs. That's a healthy margin, especially in the competitive software market. It tells us they're managing their direct costs effectively, even as their business scales. When we look at their operating expenses, sales and marketing costs went up by about 17% to $35.8 million. This increase is mostly due to hiring more people in sales and marketing, and also from increased spending on marketing campaigns. As a percentage of revenue though, these costs actually went down slightly, meaning they're becoming more efficient at turning marketing dollars into sales. General and administrative expenses, which cover things like finance, legal, and HR, went up by about 8.4% to $19.7 million. Most of this increase was again due to more personnel costs. Importantly, as a percentage of revenue, these costs went down significantly from 23%. This indicates better efficiency in managing the company's back office operations as revenue grows. Research and development expenses, which are crucial for any tech company, increased by a modest 3.7% to $13 million. Even though overall R&D dollars went up slightly, as a percentage of revenue, these costs decreased. This suggests they're investing smartly in innovation without letting R&D costs outpace their sales growth. Perhaps the most telling figure is their operating margin, which shows how profitable the core business is. Their GAAP operating margin for the quarter was 7%, a significant improvement, a negative 2.7% last year. Even better, their non-GAAP operating margin, which removes certain one-time or less predictable costs like stock-based compensation and amortization of acquired assets, came in at a strong 18.4%. That's a big jump from 11.2% in the same period last year, a nearly 7 percentage point increase in operating margin. margin is a really positive sign of improved efficiency and profitability. And let's not forget their key business metric, annual recurring revenue or ARR. It shot up 27% year over year to $367.6 million. This metric is essentially the annualized value of all their active customer contracts. A 27% jump here reinforces the strong growth trend we're seeing in their SaaS business, suggesting they're acquiring new customers and deepening relationships with existing ones. Now, what about their cash situation? For the first 6 months of 2025, AvePoint generated $20.8 million in cash from its operations. That's a slight decrease from the same period last year, but still positive, which means their day-to-day business is bringing in more cash than it's spending. On the investing side, they used $34.3 million. A big part of this was for a business acquisition, spending about $14.9 million to buy a company called Identic and another $12.1 million to buy out minority shareholders in another company. They also spent on property and equipment, which is normal as a growing company expands. In financing activities, they brought in a huge $146.8 million. This came from customers exercising their stock warrants and options, essentially buying more shares of Avo. They also spent about $19 million buying back their own stock through a repurchase program. Interestingly, they also made a move affecting their warrants, planning to redeem them in July. This usually happens when the company believes its stock price is strong enough to make warrant holders cash them in. And there's a pretty significant subsequent event to note. On July 4th, a new law called the OBBBA was signed. This law has tax implications and AvePoint is still assessing exactly how it will affect them, but it's something to keep an eye on. So what can we take away from all these numbers? AvePoint is clearly in a growth phase with a strong shift towards their high-margin SaaS products. Their operating efficiency is improving, and they're managing their expenses well, even as they expand globally. The increase in AR and the strong SaaS revenue growth are very encouraging signs. While they did spend money on acquisitions, which is expected for a growing tech company, competition, economic uncertainty, and the need to keep innovating, but overall, AvePoint seems to be executing its strategy effectively. Their financial health looks solid, and the move towards recurring revenue is a smart long-term play. Let me know in the comments what you think about AvePoint's performance. Did these numbers surprise you? If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description below to keep the conversation going. Thanks for watching, and I'll see you in the next video.